Have you ever wondered if you can really grow wealth by investing in stocks, but you don't want to jump on the bandwagon of the latest crypto coin or the newest meme stock? Then you, my friend, might just love value investing. Today we're going to break down exactly what value investing is, why starting early is key, the magic of compound interest, and even how you could live on dividends. Yes, live off them. And of course, we'll talk about the taxes you need to be aware of here in the UK, because the taxman always wants his share. But don't worry, we've got a few tips to keep him at bay. Let's start with the basics. What is value investing? Sounds a bit vague, doesn't it? Well, value investing is the strategy of buying stocks that appear to be undervalued by the market. You look for quality companies, strong balance sheets, steady profits, that for whatever reason are being traded at a lower price than they're actually worth. The key word here is undervalued. Think of it like finding a £100 note for £70. Bargain, right? And if you find that bargain and then find another one, well, now you've got money to afford that overpriced coffee in London. £5 a latte, you know the one I'm talking about. Investors like Warren Buffett swear by this method instead of chasing trendy stocks. Value investors focus on the long-term growth of well-established companies. Now let's talk about the when of value investing. The earlier you start, the better. Why? Because of the magic of compounding. Think of compounding as the snowball effect for your money. If you invest £1,000 today and your investment grows at, say, 8% per year, in 10 years, that £1,000 will almost double. And after 20 years, well, it's nearly quadrupled. The more time you give your investments to grow, the more powerful that growth becomes. Starting early is like planting a tree. The sooner you plant it, the bigger and stronger it'll be down the line. And honestly, who doesn't want a money tree? Plus, you can then tell your mates in the pub you've got a portfolio while they're still trying to pay off their student loans. Winning! Okay, so maybe you didn't start investing in your 20s or 30s. Is it too late? Absolutely not. While it's true that starting early gives you an advantage, there's still time to make your money work for you. If you're starting later, you may need to invest a bit more upfront or focus on higher yield opportunities, but the principle remains the same. Buy undervalued stocks and let time do the heavy lifting. Just remember, time in the market beats timing the market. Even if you start in your 40s or 50s, consistent smart investments can lead to serious gains. And let's be honest, 40 is the new 30, right? Just with more wisdom and hopefully fewer questionable fashion choices. Now let's really dive into this compound interest business, because it's practically the closest thing we have to magic without the Hogwarts letter. Imagine your investment earns 7% annually. If you've invested £10,000 after 1 year, you've made £700. But the next year, you're not just earning interest on your original £10,000, you're also earning interest on that £700. So by year 2, it's as if your money is working a second job. And after 20 or 30 years, your money is basically a whole army multiplying faster than you can keep up. This is why early investing is so powerful. Compound interest over time does all the heavy lifting. Ever wondered if you could one day live off your investments? That's where dividends come in. Many value stocks pay out dividends. Basically, a cut of the company's profits directly to you as a shareholder. Over time, if you invest in dividend-paying companies and reinvest those dividends, you can create a stream of passive income, and one day, maybe sooner than you think, that dividend income could be enough to live on. Yes, living off dividends. Imagine being paid just for owning a slice of a company. You're basically a silent partner, minus the suit and board meetings. Let's say you own £100,000 worth of stock in companies paying a 4% dividend. That's £4,000 a year in passive income, enough to cover some bills, or at least all the avocado toast you could ever want. Now let's talk about the part no one loves: taxes. In the UK, there are a few things to be aware of when it comes to dividends. First, let's talk about the personal allowance. Everyone in the UK gets a personal allowance, which is the amount of income you can earn before you start paying tax. As of now, that allowance is up to £12,570. If your total income, including your dividend income, falls within that, you won't pay any tax. Next, we have the Dividend Allowance. This is a specific allowance just for dividends. For the tax year, the 6th of April 2024 to the 5th of April 2025, the dividend allowance is £500. For the previous tax year, it was £1,000. If your dividend income is below this amount, you won't pay any tax on it. If your dividend income goes above the dividend allowance, you'll need to pay tax on the excess. The rate depends on your income bracket. Basic rate taxpayers will pay 8.75%. Higher rate taxpayers will pay 33.75% because, of course, the taxman always wants his slice of the pie. But here's the good news. Dividends from shares held in an ISA, individual savings account, are completely tax-free. So if you want to avoid paying tax on your dividends, investing within an ISA is a smart move. ISAs give you the freedom to grow your investments tax-free, and you can even withdraw from them without paying any tax. So, to recap, personal allowance up to £12,570, no tax on any income within this. Dividend allowance up to £500 for tax year 2024, 2025, £1,000 for 2023, 2024. ISA, keep everything tax-free. Sounds good, right? So that's the gist of value investing and how it could help you reach financial freedom. The earlier you start, the better, especially when it comes to compound interest. If you're interested in platforms to get started personally, I use Hargreaves Lansdown, Vanguard and IG, but there are many more to choose from. Find one that fits your goals. If you're unsure about your investment strategy or risk tolerance or need tax advice, you might want to consult a professional. Let me know in the comments if you have any questions. And if you found this helpful, don't forget to like and subscribe. Thanks for watching, and here's to your financial future.